Bitcoin is crashing as the Federal Reserve effectively pulls liquidity out of the system, and the next 6 hours could determine whether we're looking at a controlled correction or the beginning of a deeper capitulation phase. While you might be staring at your portfolio in panic right now, there's a game unfolding behind the scenes that only a few truly understand. And that's exactly what we're breaking down today. The latest U.S. labor market data came in stronger than expected. Non-farm payrolls beat forecasts by a wide margin, unemployment remains stable, and within minutes the market sharply reduced expectations for near-term Federal Reserve rate cuts. The result? The U.S. dollar index is pushing higher, 10-year Treasury yields are climbing, and Bitcoin has lost its grip above $67,000. Right now, we're fighting in the $64,500 to $65,000 range after failing to secure a sustained close above $67,000. This is not random. This is macro. When the dollar strengthens, global liquidity tightens. And over the past several years, Bitcoin has been extremely sensitive to that dynamic. We saw it in 2022 when the DXY surged to new highs and Bitcoin collapsed from $48,000 to $17,000. We saw it in March 2020 when liquidity vanished and Bitcoin dropped 50% in a matter of days before central banks turned the money printers back on. The market is playing a game you don't see, a game between liquidity and scarcity. And this is where things get intense. On-chain data from Glassnode shows that wallets holding more than 1,000 Bitcoin have been net accumulating over the past 72 hours. While price is falling, the number of coins being withdrawn from exchanges is increasing. Arkham Intelligence reports significant outflows from Coinbase into cold storage wallets. While you're panicking, the whales are methodically accumulating. That's not coincidence, that's pattern recognition. At the same time, the derivatives market is showing a sharp increase in open interest, especially around the $63,000 put options expiring within the next 24 hours. That means if we test the $63,000 level, we could see a gamma effect kick in. Market makers would need to hedge aggressively, amplifying volatility. It's like a beach ball being forced underwater. The longer it's suppressed, the more violently it explodes upward or downward. So why are the next 6 to 12 hours critical? Because today we get the weekly jobless claims data. Another strong reading would reinforce the higher for longer interest rate narrative. Markets would push rate cut expectations further out. The dollar could strengthen again, and Bitcoin could test the structural support at $63,000. This isn't just a psychological level. It marks the volume cluster from the previous consolidation phase and sits near the short-term holder realized price. Historically, these are the moments that matter most. In 2017, we saw multiple 20% to 30% corrections within the broader bull market, each accompanied by macro uncertainty. In 2020, after the halving, there was a period where strong economic data created short-term pressure, before Bitcoin transitioned into a parabolic move. And now in 2024, following the most recent halving, we're seeing a similar post-halving structure. Supply cut in half, miners selling less, long-term holders remaining steady, but short-term macro shocks creating volatility. This is where scarcity enters the equation. Since the last halving, daily new issuance has dropped to roughly 450 Bitcoin per day. Meanwhile, on strong inflow days, spot ETFs absorb multiples of that amount. Even during this correction, data from major issuers still shows net inflows into spot Bitcoin ETFs, albeit at a slower pace. That means structural supply is limited. Every dip runs into a wall of long-term capital waiting for exactly these moments. Samson Mow often talks about the Omega candle, that single explosive move when supply and demand become completely imbalanced. And what many don't realize is this: those moves aren't born in euphoria. They're born in fear. In moments when retail is selling while institutional players are quietly building positions. The options market is signaling elevated implied volatility for the next 24 hours. That tells us the market expects movement. The question isn't whether we'll see volatility. The question is which side's liquidations get triggered first. Below $63,000, there are significant high-leverage long positions. A breakdown could trigger a cascade, a final capitulation that looks like one brutal, fast candle. But right there, aggressive spot buyers could also be waiting. Now let's talk psychology. While you're asking yourself whether you should sell, professional traders are asking, where is the maximum liquidity? Where are the stop losses? Markets don't move randomly. They move toward liquidity. If everyone is watching $63,000 as support, that's exactly where emotions are most concentrated: fear, hope, leverage. The short-term correlation between a strong dollar and weak Bitcoin is clearly visible. But long-term, Bitcoin remains a hedge against monetary expansion. If economic momentum slows later this year and the Fed is eventually forced to pivot toward rate cuts, the entire narrative flips again. We saw something similar in 2019. First tightening pressure, then a policy pivot, and Bitcoin launched into a powerful rally. Right now, we're at a crossroads between short-term macro pressure and long-term supply contraction. Data shows that long-term holders still control over 70% of the circulating supply. Coins that haven't moved in more than a year are at a cycle high. That's not typical behavior at a market top. That's structural accumulation. The next few hours are critical because they will determine whether we see a technical flush or whether the $63,000 zone becomes a launchpad. Like that beach ball underwater, pressure keeps building. The only question is, who lets go first? Drop a comment below. Do you think we test $63,000? Or do the bulls defend this level? Let's keep it rational and data-driven, not emotional. That's the difference between traders and investors. In the end, this isn't about panic. It's about understanding. The market is playing a complex game of liquidity, psychology, and scarcity. If you learn to recognize these patterns, whale movements, ETF flows, macro data shifts, options positioning, you start seeing more than just red and green candles. And maybe then you realize this crash isn't just a drop. It's a test. A test of your conviction, your strategy, and your ability to separate noise from signal. The next 6 hours will show who is truly prepared.